Let's talk about loan types, what I generally think is dry material, but apparently you guys love it.
She said, I want the lowest possible monthly payment. This is the amount of cash I have to work with. I don't care about closing costs. I want the lowest possible monthly payment. You can qualify with lower credit scores down to 580. And if you're putting 10% down, some banks will go down to 500.
Oh, wow.
So really low credit. Minimum down payment's 3.5%. Typically lower rates than conventional products.
This is what a great lender does, is they are weighing all of these things. They're like, okay, we've got this upfront MIP here, this interest rate, we've got this down payment, whatever.
A house that's worth $1 million right now, but you have $500,000 mortgage balance. HELOCs and HELOANs give you the ability to tap into that equity. I actually recommend a lot of people do this. Let's say you paid cash for your house, okay? Then you bought $1 million house cash. I would recommend you go get a HELOC up to whatever you wanted, up to 80% of the value, and just leave it.
As promised, we are back with a mortgage episode about one of the most frequently asked questions that we get, which is around mortgages and loan types and how that works. We're still developing some of that content for you guys, so you may see some other stuff come from us about mortgages. But hey, do me a favor, as you subscribe to the podcast, if you haven't before, put a comment and tell us why the mortgage episodes are so popular. It's so interesting to me. Every time we put a mortgage episode out there, it gets tons of traction. And so give us an idea, why are those mortgage episodes so catchy? Anyway, I'm just interested to know. So let's jump in. Let's talk about loan types and what I generally think is dry material, but apparently you guys love it. Let's do it. Yeah. But, I think there is a lot of confusion, frankly, about loan types. And I think the caveat would be like, and I've said this in a previous episode, but I want you to get some information and knowledge and expertise as a real estate agent on how these loans work.
Yeah.
I do not want you trying to pre-qual somebody, as a real estate agent before they've talked to a lender, so having working knowledge of it is great, but don't take it too far, right?
Right.
Make sure you turn them to an expert so that the expert can work with them and get them pre-qualified.
I do think some basic understanding is important, and that's what this episode's for. And if you haven't listened to our last episode that was released the week of the 19th, 18th or 19th of November, listen to that episode because we did a Q&A session on mortgages. We touched on a lot of the stuff that we're going to talk about today in that episode, but this episode's a little bit more in depth. So I would say go back, listen to that one first, then circle back to this one. But today's it's all about different products, and we won't go into every possible product that's out there. It would take too long, but we're going over most of the big ones, and I think it'll be helpful. So
what's the first one on the docket?
Let's start with conventional. I mean, it's the easiest one to start with. So conventional loans are non-federally backed loans, although they are backed by one of two entities, Freddie Mac or Fannie Mae. Sorry. Those are two GSEs that they're backed by.
What's a GSE?
Government-sponsored entity.
Okay.
So they're sold to either Fannie Mae or Freddie Mac, and so they're typically rather safe for lenders.
Right.
They're safe products because they're backed. The guidelines are baked. They're not exactly the same on Freddie Mac and Fannie Mae, but they're very similar. They're a little bit more stringent than some of the other products we'll talk about. So conventional loans are a little harder to qualify for. Typically thought of as someone with better credit.
Yes.
Not always, but typically thought of that way, mainly because most lenders require you to have a 620 credit score to qualify for a conventional mortgage.
Right.
So 620 is your minimum. And then down payment varies based on a couple different scenarios. So let's talk about first-time home buyers. So first-time home buyer is you haven't owned a primary home in a number of years, three to 4 years, and or you've never purchased a home, period. Which those are two ways you can be a first-time home buyer. And just one of the borrowers on the mortgage needs to qualify for that to be a first-time home buyer loan. And so if you've got like husband and wife, and husband's bought but the wife hasn't, but the wife's on the loan, still a first-time home buyer. The benefit for that in the conventional space is you can put 3% down.
Yeah, there's a 3% product.
Yeah.
Yeah, which I think most people think conventional, they think 20% down, but there's a 5% product. They're 10, 5, and 3.
Yeah, and actually some wholesale lenders have a 0% down product in conventional.
Oh, I didn't know that.
That it's you got to be a first-time home buyer. This is just one example of one, but you got to be a first-time home buyer, and you have to be under 80% of the area median income. And those median income levels are published, and you can only be at 80% of that. So then you can, even qualify for 0% down. But in general, 3% down is the minimum for a first-time home buyer. If you are not a first-time home buyer, you can put 5% down still. So a lot of people think conventional means 20% down. That's not the case. So you've got a 3% option and now a 5% option. And then, from there, there's a number of other, differences about conventional mortgages. One would be, how much seller concessions you can accept. So if you put below 10% down, you can only accept 3% worth of seller concessions. 10% or more, you can accept 6%. If you put over 25% down, you can accept 9%. So there's a couple different kind of caveats there to conventional mortgage project.
Yeah, I guess the incentive is to put more down if you want those concessions, but it's a little bit more of it's like, okay, well, you're showing that you have more money, there's less risk in the loan, so on and so forth. Yeah,
and I would say the other kind of major benefit here is if you put 20% down, you can avoid PMI or private mortgage insurance.
Yeah.
And so that's, if you're putting 20% down, a lot of times, and you got a good credit score, we're instantly moving towards a conventional mortgage product because you don't want the PMI. You've got the higher credit scores, so you're going to get decent rates and whatnot.
So as of right now for a conventional product, and I'm sure this varies, but do you have like a percentage or what that PMI is going to look like at 10% versus 20%?
Yeah, it's a half of 1%.
Okay. All right, so 0.5%.
Roughly. I mean, every lender's a little bit different.
And then that's going to be, so yeah, your payment's going to be higher if you have PMI, but with a conventional loan, right, once you kind of get to a certain level, that can drop off, correct?
It can drop off. So it will automatically drop off once you get to 78% LTV.
Okay. But you don't want to wait for that.
No, you can call and request it at 80. Some lenders will do it. Some lenders will make you get to 78%.
Okay. All right. Good to know.
Yeah.
All right.
And then the other thing is just DTI limits, right? So they're a little bit more stringent than some of the other products. Some lenders will allow you to go up what's called 50-50, meaning 50% front end, 50% back end. That's pretty high. There's not many lenders that will do that. There's some lenders that cap out much lower, like in 40% range. But the difference between front end is the front end is only looking at your monthly mortgage payment to your income, and then the back end is looking at everything. So car loans, student loans, all of it rolled in together as your back end DTI, meaning debt to income ratio of all your debts to your income.
Right. So here's the question. Who is a conventional loan for mostly?
Borrowers with good credit and I would say larger down payments, because if you start to, let's say you are a first-time home buyer and you do qualify for that 3% down, okay? And let's say you have a 700 credit score. You're going to be paying PMI. There's a couple different, rate changes that are going to hit you based on where your credit score is and all these things and how much you're putting down. And the rate's going to be much higher than say like an FHA loan. So, and you're still paying PMI. So I would say, good credit, decent down payment.
Okay. Does that wrap us on conventional?
Yeah.
Okay. So what's next?
Let's talk about VA.
Okay.
So these are guaranteed by the U.S. Department of Veteran Affairs. And this is mostly thought of as a 0% down product. Now, you can put money down.
Sure.
But a lot of veterans use the option to put 0% down, which is great. There is a funding fee. It's usually, it's about 1.25% to 3.3%, depending. That fee can be waived. If you're a disabled veteran, some other things come into play on whether or not it can be waived or not. But you do have a funding fee, so that's a negative. And the rates are great. So because it's guaranteed by the U.S. Department of Veteran Affairs, the rates are much lower. DTI limits are much higher. So you have the ability to go up to higher DTI ranges. But it's a great product. If you're a veteran, no brainer, you should be using this product.
Yeah, absolutely. Well, I try to use it. But yeah, 0% down, you're right. And what I would say for listing agents out there, if you get a VA loan offer, a lot of times that earnest money will be kind of light because they're putting 0% down, right? Or they, maybe they're throwing $500 or $1,000 So that's just good for your sellers to know. It's like, hey, if we get a VA, that's normal for that to be light on earnest money because they're not putting a substantial amount down payment in most cases.
Yeah.
Most of them, I would say most of the VAs I've seen are exercising their 0% down.
Yeah. I mean, I think that's fair to say. But really lenient credit score requirements, no down payment. It's much easier to qualify for. It must be your primary home. So that's one caveat. And 4% max seller concessions. No, it doesn't matter on down payment or any of that. It's just 4% max seller concessions.
Do they still have that weird thing where the buyer on the VA loan, the buyer cannot pay for the termite inspection?
Yeah.
Okay.
There's still some, limitations on what the buyer can and cannot pay for. So that's still in place.
So again, the VA, obviously that particular loan is going to be for a veteran, right?
Or surviving spouse, active duty or veteran.
Right. Is there a reason that someone should, somebody that is a veteran should go conventional versus VA? Just depends on their individual situation, or is VA just an amazing product?
if they have the ability to go VA, no, I can't think of one.
Okay, there you go. So you veterans out there, use your VA.
You're going to have a better rate, more lenient requirements. Have to pay. Maybe to avoid the funding fee, like let's say you had a really high funding fee, but I usually no.
I would just get the seller to pay for that funding fee. You
if
can,
that's an
right?
option. Yeah, you can.
Okay. All right. Okay, what's next?
FHA.
All right. This one is I'm excited to get into FHA because a lot of people have the wrong perception about FHA. It's a really great product. And it can be very useful.
It's got a bad rap.
Yeah. Why does it get a bad rap though? I don't get that.
I think people looked at them as, kind of riskier, low income, bad credit loans. So
that's not always the case, though.
Which is not always the case.
Yeah.
But anyway, products insured by the Federal Housing Administration, minimum down payment's 3.5%. And typically lower rates than conventional products. Typically, you can qualify with lower credit scores. So down to 580. And if you're putting 10% down, some banks will go down to 500.
Oh, wow.
So really low credit score requirements. They do, the negative of this product is they have an upfront MIP. And we talked about this on the last episode, but it's mortgage insurance premium. It's upfront. It's paid at closing, 1.75% of the loan amount. So it can be high. But in our market right now, we're seeing sellers pay a lot of closing costs. And, and if they get that MIP paid for, or you can roll it into the loan, that's up to the borrower whether that's a good idea for them, because if you're rolling into the loan, you've got a lower loan to value, higher loan to value,
right?
So you can roll it into the loan, so you don't have to pay for it out of pocket, but that is a downside to FHA. Sometimes appraisals can get a little weird when they review certain aspects of the home. So if you feel like, if you've ever heard like of cracking driveways or unsafe decks or, not having railings walking into a home, things like that FHA flags, it might have to be fixed. And that's another reason why I think sometimes they get a bad rap is they're worried that the appraisal is going to get flagged for a bunch of stuff, but it's really not the case. It's not that crazy.
No, my experience with FHA appraisers is they're looking for particulars, peeling paint and, hey, is their flooring in, is one of the things that we used to get, because we did in Oklahoma in the 2010s, we did a ton of FHA. And so I would just make sure like, hey, either all the screens need to be on the windows or all the screens need to be off the windows, because if they go out there and one screen's missing, then they're going to have to do that. And then you have to find someone that's going to build a screen for you for that one. So it was like, if we were missing one, I'd say pull them all off and put them in the garage and you can put them back later. Right. But it's like one or the other.
Yeah.
So they would kind of ding you on little things or say if there was like peeling paint. Right. One time we had somebody that the house was like sort of under construction and they were trying to get it ready for the appraiser, and they had pulled the carpet out and we're like, nope, go put it back in, because it didn't have to be good shape. It just has to be there.
Yeah. It just has to be there.
Right. And so there were some things that we sort of danced around in an FHA, but generally speaking, it wasn't anything crazy. It was just very simple stuff. And you kind of learned the intricacies of getting those through because we did so many of them. But but why? So here's the question that I have. So would there be a situation where someone with good credit, right, that's qualified for conventional would choose FHA over conventional?
Yeah. I mean, I think, yes. I mean, let's say that you're not putting 20% down, for instance, and you're going to have to pay mortgage insurance. Now, FHA used to have a higher mortgage insurance premium monthly than a much higher one than conventional. Now they're very similar. So let's say you have good credit, but an FHA rate's coming in at like 5.8 and the conventional one's like 6.8, which I've seen.
Then, yeah, of course.
I've seen. Yeah. And you're still going to have to pay PMI on either one. Like, yeah, and now you've got that upfront MIP that I talked about that you wouldn't have on conventional. But
if you get the seller
concession,
yeah.
So, I mean, I do think there's reasons why.
Well, now, go ahead. Sorry.
It has to be owner occupied. Can't be, investment property or anything like that. And the loan limits vary by region, so it's not the same everywhere. Like the FHA sets it based on county.
Yeah, and let me tell you something. This is what a great lender does: is they are weighing all of these things. They're like, okay, we've got this upfront MIP here. We've got this interest rate. We've got this down payment. Whatever. That's not your job as a real estate agent to figure out. But also, what is your job is to find a really great lender that can help you work through all of these variables to come out with the best solution for the client, because it is to the individual.
Yeah. I had a lady in your neighborhood actually that reached out to me, and we were refinancing and I was walking through all of her options, and she said, I want the lowest possible monthly payment.
Yeah.
Lowest possible. This is the amount of cash I have to work with. I don't care about closing costs. I want the lowest possible monthly payment. Well, FHA was it for her. I mean, she could have qualified to refi into a conventional loan.
Yeah.
She chose to go FHA for that very reason, because the interest rate were lower. She was going to have PMI regardless. She didn't care about the upfront MIP. She understood it. I explained it multiple times, but she said, look, that payment's going to be $600 lower than conventional. I want it.
Okay. Yeah, absolutely. Well, I mean, that matters. So that was great. Yeah, I think her initial rate was like 8%, right?
She was in an 8.25 and she left with a 5.9. So.
That's amazing. Yeah. All right. Well, she was happy, I'm sure.
Then the other thing about FHA is condos can be tricky. So condos have to be approved by the FHA. If they're not, you can get a one-off exception, but they can be tricky to get approved for. If a lot of them are rented out, or if the HOA is behind, things like that can really cause an issue with it.
Yeah, I've run into that on an FHA for condo, because a lot of times, like a first-time home buyer, they're going to get, hey, I'm going to get a 3.5% down FHA, right? And then I'm going to get into this condo complex. But what I've run into is sometimes those condo complexes are a little older. And so let's say it's 30 years old. This condo complex is 30 years old. And I think is it over 50% of them?
Yeah.
So you have the rentals. So for 50%, more than 50% were rentals. Then FHA, then it doesn't fit inside the FHA guideline. And so that had been a challenge that we've run into before, just based on, of course, for first-time homebuyer, a condo is going to be a little cheaper, but you want to check that on the front end and make sure that, hey, how many of these things are rented? What are their sort of qualifications? What do the covenants and restrictions say about rentals? Because some condo complexes won't let more than 50% because they want more homeowners. And so, all of that is, you need to, especially in condo complexes, look into it before you bring somebody into there, because you don't want somebody buying a house where 2 weeks were past the inspection and then they go, oh, this one doesn't qualify FHA.
Yeah. So
anyway,
the last thing I'll say is on FHA is just that mortgage insurance does not automatically roll off at 20% down. Mm-hmm. So if you put more than 10% down, it stays for 11 years. If you put less than 10% down, it stays for the life of the loan.
Yeah.
So those are the kind of the caveats to those. So if you're okay with that, or you think you might refinance out before those come into play, then it's still a great option.
What's our next?
USDA. Don't do a lot of these.
They don't come up as that much.
Yeah. I mean, guaranteed by the U.S. Department of Agriculture. They have income limits on these loans. Mm-hmm. If you have a certain income, you cannot do these loans. They do have an option for 0% down, so that they are for rural areas and with lower income families with lower credit scores in rural areas.
Okay. Yeah.
So that's their target market. You have to be in like a USDA qualified zone to even look at these as an option. But still out there, still a good product if you need 0% down and you're in a rural area.
Okay, can I put you on a spot with one? I bet you that's not on your list.
What's
Is
that?
Okay, we'll see how good you are. Native American loans, because we ran into a lot of these in Oklahoma. Yeah, they're 0% down, right?
Yeah,
so
I don't know much about those. Yeah. I mean, I'm aware of them, but I'm not.
Yeah, it's
privy to a lot of the guidelines.
It's a lot like VA, right? It's a lot like VA, or in that case. So yes, it's 0% down.
Yeah, so. I am aware of them. Actually, I had a guy in our brokerage just do one recently, but I don't do that.
Well, I used to ask folks in Oklahoma specifically because there's so many Native American communities in Oklahoma. And so I say, okay, 2 questions before we get started. Are you a veteran or are you a Native American? Because that sort of changes the what we can kind of do from a loan perspective.
Just like I teach real estate agents, like refer out to a good lender partner, I would do the same with that type of loan. Like I'm aware of that loan and I know it exists. And I actually have a couple banks that I work with that do them. Yeah. But that would probably be one where I'd refer them out to somebody who does those loans. I would just be like, hey, I know Jerry does these loans. I'm going to refer him out to Jerry.
Yeah. Okay. So that's USDA. And then what's after that?
And the only thing I'll say about USDA is 6% max seller concessions. Okay. So mortgage insurance is always required too. So
I mean, basically, and can you find like a USDA map? You can find that online, right?
Yeah.
So if somebody wanted to say, hey, I want to live maybe in one of these rural areas and get a 0% down, I'm okay with a little bit of a drive in. They just could pull up the map. And find.
The only thing we just have to check their income, make sure it's below the limit.
That's right. Okay. Good to know. All right.
Jumbo loans. So these are loans that are above the FHFA conforming limits. So they're considered, but I think most regions it's 766, 650. But there are some regions where it's like 1.15 million ish. But those are loans that are above those conforming limits, right? So banks are going to have different guidelines on these products based on their risk tolerance. But in general, they require higher credit scores and higher down payments.
Yeah, and they're usually higher interest rate, right?
Higher interest rate too. Yeah, because they're considered riskier loans.
Sure.
They're not backed by the GSEs and all these things, so they're just riskier products.
Yeah, I've run into several jumbos in my time, and it's kind of a bummer because that interest rate is up there, right? It's usually what I've seen, and I don't know this, but what I've seen is like 1% higher. Is it
not quite, but can be. I mean, so most, like for instance, United Wholesale Mortgage, lender I use a lot, right? They have a pink, green, I think it's blue product for jumbo loans. Pink is like lower down payment, lower credit score, then it works its way up. Now, I might have those wrong, but something like that, where it's like a lower down payment, lower credit score, working its way up to a higher down payment, higher credit score. And for the higher down payment, higher credit score, the rates are very similar to conventional actually. But for the riskier products, they're going to have maybe 1%, maybe more as far as rates concerned.
Yeah. And so I understand. So it's the loan amount that can exceed that value, or is it the purchase price?
It's the loan amount. Yeah. Loan amount.
Okay. So the loan amount couldn't, what was the first number?
766, 650.
Yeah. So that loan amount can, and for the other one, 1.15.
Yeah.
But so if they came with a little more money or 20% down and that got them under that loan amount, then they wouldn't have to do the
If people are close, I'm always coaching them, like, hey, let's get this a little lower, get it in a conforming loan. And
okay, just so you don't have to pay the higher interest rate. Okay, that makes sense.
If they're on the bubble.
And I've seen that happen a lot in new construction where builders are building just under that, that jumbo, so that because it's going to affect their sales, right? So it's like, okay, if people have to do another percent or, a higher payment or a higher interest rate to get into one of our homes. So they'll keep the homes just under that amount. Yeah. Yeah. It's interesting in development. Okay. What's after that?
Let's see. ARMs.
Yes. I don't know very much about them. All I know about them is they are partially to blame for the big housing crash of 2008.
Yeah, partially. So ARMs have their place.
Yeah.
For instance, if you're not going to be in the home for longer than the fixed rate period and the fixed rate is lower than the current conventional rate, might be a great option.
Okay.
Like, for instance, let's say you're doing a 5-6 ARM, right? What that's telling me is that There's a fixed rate for the first 5 years, and then the rate will adjust every 6 months, 5, 6.
Okay.
So every 6 months, whatever the current, kind of rates are, they'll do like Prime Plus or whatever it is, and they'll adjust based on that every 6 months. So let's say that right now the fixed rate for an ARM is lower than the conventional, and you think rates are headed down, not up. Might be a good option.
Okay.
But some people are like, you know what? I just want a fixed rate. I want to make sure I understand my payment at all times. I don't have any risks.
Yeah.
I don't do a lot of ARMs. I don't love them. They're not bad products. They have their place again. But I honestly, most banks right now are pricing their fixed rate portion of the ARMs very similarly to conventional. So I would just take the conventional.
So it's not even worth it. Yeah. It's for the difference. Okay.
But yeah, I mean, those are the big thing with ARMs, right? So like they have their place.
Yeah, I think so. And I've seen them done before, but typically what happens is before that fixed rate is completed, people refinance into it.
Yeah. So that would be a great example.
To a conventional product.
Yeah. Let's say you knew you liked the rate on the ARM for the fixed portion. You knew you were going to refinance before the fixed portion was up. Hey, use the ARM. It's fine. Or
some people, I remember they were just sort of like just coming to town for like a job assignment that was going to be 2 to 3 years. And so they were going to buy and sell anyway. So.
Yeah, I hate to go back to a product, but conventional, one thing too is it gives you conventional mortgages, which is the first one we talked about, does give you the option of doing second homes or investment properties, whereas some of these other loans are primary only.
Yeah.
So if you are buying an investment property, it's probably going to be a conventional loan or non-QM.
Right. What else?
HELOCs and HELOANs.
Yes.
These are very misunderstood products. I should say that I just get a ton of questions about them. So HELOCs and HELOANs are two different ways you can use your home equity, okay? So let's say that you had a house that's worth $1 million right now. If you got an appraisal, it'd come in at $1 million, but you have $500,000 mortgage balance, okay? So you got $500,000 in equity. HELOCs and HELOANs give you the ability to tap into that equity. So they're basically like a second lien on your property. So you've got the first lien, which is the mortgage that's got a balance of 500, and then you can, get a HELOC or a HELOAN for a portion of the remaining equity. I say a portion because no lender is really, I don't know of any lenders right now that are allowing you to take out a HELOC that takes you all the way up to that $1 million valuation.
Oh, too much risk.
There are some that'll do 90 or 95.
Okay.
Which is pretty high.
That is high. It's super high.
But the large majority of banks will do 80%.
Well, the other thing that happens is you're right. So it'd be 90 to 95, but the appraisal that they do is different. It's not like a purchase appraisal. It's a little more.
Can be.
Okay.
Most lenders, to make it quick and easy, will do what's called a desk appraisal or drive-by appraisal, where they'll just see what they think the valuation is based on reviewing area comps and whatnot. But there are companies that will go out, like Pentagon Federal Credit Union is one. They'll go out and do like a full appraisal, like a normal purchase appraisal.
Oh, really?
Yeah.
Okay. So are they shooting for a value though? I think that's the question.
Appraisers are never supposed to shoot for a value.
Yeah.
They're just supposed to,
they're not supposed to.
No, but I mean, I would have to do a little research. I'm not sure if they even know what value they're estimated.
Yeah, that's the difference.
Yeah,
because
I don't think because they don't have a contract, right?
Well, right, they're not supposed to shoot for a value, but I mean, let's be honest for a second. An appraiser, most of our loans, right? Most of our appraisals are coming in at value, maybe a little bit above, right? 80% of the time, or maybe another 20% they come in low, right? So, but they see that they're trying to hit the number. Right, so they're pulling comps that are going to basically support the value. But if you're doing a HELOC, they don't. You're right, they're not seeing anything, right?
Yeah, I don't think that they are. I don't know that for a fact, but I do not think that they have like a number.
If you're an appraiser and you're listening, comment and let us know how that works.
Yeah,
it'd be interesting to know.
So a little difference between the two products. So a HELOAN would be more like you took out $200,000 to do this home renovation project, and you're going to start paying that back kind of immediately. There are some that have different terms, but for instance, let's say you have a specific amount of money you want. You're going to take it out and start paying it back. The HELOC is more of a line of credit. It's a home equity line of credit, LOC. So in that case, you can get, and I actually recommend a lot of people do this. Let's say you paid cash for your house, okay? And you, Brandon, walked in, you bought $1 million house cash. I would recommend you go get a HELOC up to whatever you wanted, up to 80% of the value, and just leave it. Don't take any money out of it. Zero balance, so you're not going to pay any fees. You might pay a funding fee of $1,000, but it's like it's your safety net. Like, let's say you lost your job tomorrow, somebody got disabled, you needed cash, you've got it. It's right there, and you can pull from it and pay back. So typically a HELOC, and different products have different terms, but a very standard one would be a 10-year draw period, meaning you can take out of that HELOC for 10 years, take or pay back for 10 years. And then at the end of that 10-year period, you're now in the repayment period. So you've got 20-year repayment period. So 10-year draw, 20-year repayment. So during the draw period, you're only paying interest on what you took out. So if you didn't take any money out, you're not paying anything. If you took money out, you're paying interest on that. And then once you get to your repayment period, you're paying principal and interest all the way back to when it's paid off. So last two are I would say last three. Let's just lump them all in one big bucket. Portfolio loans, construction to perms, and non-QM. Okay, non-qualified mortgage. So let's start with portfolio loans. These would be loans that a bank intends to keep as a portfolio product, and they can kind of, because it's not a normal conventional loan, FHA loan, VA loan, whatever, they can kind of determine what risk they want to accept, because the bank itself is loaning the money, and they are the ones that are going to keep that loan and not resell it.
Right.
They can come up with whatever terms they want. They can take it on as much risk or not take on as much risk as they feel like is appropriate. So portfolio loans would be like normally a bank saying, hey, we're going to offer this product that nobody else in our market's offering, and it's just a niche product.
I've seen like portfolio loans offered to like somebody that wants like a doctor or something like that, where they'll kind of just do whatever they want to do and kind of work out that loan.
Yeah.
It works really well.
Yeah, a lot of those physician loans are kind of very similar to what I'm talking about here.
Yeah.
So like most of the time, brokers don't compete very well on physician loans, like brokers like myself, because banks can kind of come up with whatever they want, right?
They're just making it up.
Yeah, they're like, hey, this person's gone through a decade worth of school. They're now opening their own practice. We're pretty comfortable with loaning them this money. So they may go off and say, all right, 0% down, you can go up to $3 million loan and, whatever.
Right.
So, and, a broker's not going to compete on that, because most of the products that we have access to are not from traditional like brick and mortar banks. They're more from wholesale lenders.
Yeah, exactly. Okay.
Construction to perm would be like you bought a piece of land and then you got a construction loan, and you start paying interest-only payments on the construction loan, and the perm piece is creating it all, at the end, turning it all into one permanent loan, right? So you wrap the land loan, the construction loan, all into one conventional mortgage box at the end, and move on with a normal mortgage.
Okay.
Those are popular, obviously, if you're doing your own custom build or something like that.
Sure. Well, I've seen a lot of this. I mean, I really, moving from Oklahoma to Tennessee, I see a lot more of this sort of portfolio, non-QM. And I think probably a lot of it's just specifically in the area that we live in Franklin, because there's a lot of entrepreneurs, right?
Yeah.
And so there's, so there's a lot of just sort of like new business getting started, and so yeah, it's been kind of interesting to see people kind of go and be able to grab a bank statement loan or, something that's just done off. Just non-QM stuff, which I just had not seen very much of it until now. So
non-QM, that's our last one, would really be like you just said, a bank statement product or something that's like what we call alt doc, or like different documentations required to get the loan to closing. They don't follow any of these normal guidelines. They're kind of they're products that these lenders come up with that get people loans that wouldn't normally have access to loans. So like let's say, for instance, we talked about on the last episode tax returns, right? Your AGI matters. Well, let's say that your AGI is only $50,000, but you got tons of money coming in. You got a lot of expenses that you're writing off for tax purposes.
Right.
Well, you could do a non-QM loan, do a bank statement loan, and they'll say, hey, look, we see that you have $60,000 a month coming in, like every month. So that's what we're gonna use as your income.
Right.
So it's just a way for people to get loans that wouldn't normally.
Okay. So what would be sort of the main takeaways from the episode?
And we just scratched the surface on products. There's more out there. Yeah. I think that's the takeaway is like, you start to realize that why you shouldn't advise clients from a real estate perspective on loans, because all of those loans we just talked about, guidelines change all the time.
Right.
Like we'll get notices that Fannie Mae or Freddie Mac changed this or changed that. We just got one back in September in which there was a decently significant change about how alimony is treated, for instance, as a liability or not. And so like those kinds of things, like you start to see that one little guideline can drastically change the landscape of what loan you may or may not qualify for. So speaking on it as if you are sure whether or not they're going to qualify or not, it's very hard to do.
Right. Okay, as always, thank you guys for joining us. Make sure to like, subscribe, and we will see you next week. Bye.